All right. This is our final panel. Thank you so much for sticking with us all today. So I am really grateful to have this amazing panel of investors focusing on climate tech. And we've got Raychel Espiritu from the Alliance for SoCal Innovation, who will be moderating this panel. And so yeah, please hold your questions till the very end. But yeah, we'll get into it right now. Here you go, Raychel.
Awesome. Thank you, Tad. Hello, everyone. My name is Raychel Espiritu. I'm Venture Outreach Manager at the Alliance. I oversee a program that helps connect founders to investors. Really excited to be here today. Thank you guys all for agreeing. Would love to just have everyone introduce themselves, talk about your investment thesis, and example of portfolio companies.
Thanks, Raychel. Kyle Adkins, partner at FullCycle Climate Partners. We're a late-stage crossover fund that's bridging the gap between venture capital and project and infrastructure capital. When you think about investing in climate, you need to be investing in the atoms, right? And so traditional venture is not necessarily well-suited for that, and so we are purpose-built to basically be the bridge between those two worlds. And so we're looking for technologies that have been proven and been validated by early-stage investors and are ready for that rapid commercialization that comes about that needs a different source of capital. And we basically can provide both of those as a bridge between those two worlds. And so when we think about the types of things within climate that we're very focused on, we're looking at commercializing the next classes of infrastructure technologies that are going to be like solar and wind one day, and finding those and identifying them earlier and scaling them and getting them up the curve a lot faster than the 40 years it took to get solar and wind to the commercial scale that it's at today. And so when you think about the types of companies that we're focused on, stuff around waste circularity, industrial processes, agricultural technology, and other stuff in and around the energy transition, new sources of renewable energy and whatnot. But we're looking at stuff like converting waste to value. We've got a business that can do plastics out of mixed municipal solid waste. We've got a circular fashion business that can take textile waste and convert it into a 100% waste content fiber that has the ability to replace up to 90% of the fibers that are out there today, including all the synthetics of fast fashion and whatnot. But it's a bio-based solution starting with waste. So these are the types of things that we're really focused and excited about spending our time on. So looking for the conversation today.
Valentina Rodriguez. I'm an investor at Wonder Ventures. We're an LA-based and focused pre-seed and seed fund. We're generalists beyond our kind of core thesis and geographic focus on great teams building in LA. So we've invested a lot in climate tech purely because there's a lot of great talent in LA building in the space. Actually, over a third of our investments in this latest fund, we're now in our third fund, have been within the climate tech space. And that's kind of it on our end.
Don't touch the bottom, right? So I'm Tarek. I'm founding partner at Type 1 Ventures. Type 1 Ventures is an LA-based. We have an office in the UK as well. But we invest in anything that progresses humanity forward towards a Type 1 civilization. If any of you are familiar with the Kardashev scale, it says there's a Type 0 civilization, a Type 1 civilization, and a Type 2 civilization. I'll go from top down. So Type 2 is like a Dyson sphere. We're 1,000 years away from that. Think Star Trek. And a Type 1 civilization, we're probably 50 to 100 years away from that. Right now, we're a 0.7 civilization. A Type 1 civilization can harness all of the energy on its planet that reaches its planet from its home star, tidal waves, all of the renewable energy on its planet. And you take that amount of energy stored and harnessed, and you can extrapolate what kind of technology we have. So we're investing in space tech, we're investing in deep tech generally, and also fintech, because we see fintech has an impact towards lifting people out of poverty, which ultimately has an impact positively on the environment. So right now we're on Fund 2. We oversubscribed our second fund. It's a $55 million fund. We're investing up to Series A. And some of the companies we've invested in is Spaceforge out of the UK. They're doing factories in space. They were the largest seed round in a space tech company in Europe. We've done Orbit Fab, which is doing gas stations in space, but then more generally, we've done things like wireless power transfer, data resolution based out of Israel, in Singapore. And so really happy to be here. We love LA, and thanks for having us.
Awesome. Thanks, guys. I feel like you're real life superheroes saving the planet. So really awesome to hear more about what you do. So I'd love to hear your perspective on the current, state of climate tech investing.
So we were probably pretty unique perspective on this since we're so geographically focused. And it hits to, I think, a question you're going to ask later on. But there's climate tech in any layer of tech right now. So, we invest across consumer and enterprise. We're pretty evenly split across the two right now. And the fact that we're able to touch so much of climate tech still that way just speaks to the amount of innovation that we have to make as a broad society to actually get to your type 2 society or even type 1. And so that's kind of what we're seeing from our very early, very focused perspective.
I think one of the key insights that we have been focused on is that PwC actually just reinforced it recently. They had a report that came out that showed that 80% of the future emissions abatement opportunities in terms of the technologies that you could invest in has received only 25% of the historic financial capital from climate tech investors. So most of it, the vast majority of it has gone into transport, so think electric vehicles, things like that, or energy. And those are great, we need all of that. But there is a massive portion of the overall pie and the abatement opportunity going forward that has been woefully underfunded. And so that's a lot of where we spend our time on, getting back to what I was saying earlier about stuff in and around the rest of the economy beyond that, because we're going to need to have a rapid transformation across society. And I think investors broadly in climate and frankly the institutions and everyone behind it are starting to wake up to that and realize that it's going to require us doing a lot more than just electric vehicles and lots of renewable power. They're going to need a lot more than that. And so that's really what we're seeing right now is people starting to pivot and see that it's that plus a lot more that we can be doing alongside that.
My view on it is more so generalist around technology. So I'm a technologist, and I think technology in general will solve climate change gradually. And so things like fintech, where most people don't really think of it as a climate-focused area, actually have an impact on climate change. Because if we look at the developed world is putting a lot of resources top down, say governments and big corporations saying, okay, we need to be carbon conscious. But the developing world, when GDP per capita is below 5,000, most people are in a survival mode, and those people honestly aren't worried about the climate. And so what we need to do as a society is invest in things that will bring people out of poverty as quickly and as humanely as possible. And so I think fintech, more technology, is key. So generally speaking, I think climate tech is something that needs to be looked at everywhere. Everything needs to be climate tech, but it shouldn't just be like, oh, we need to radically change everything. It has to be gradually, and it has to be from the bottom up as opposed to the top down. And that's just my personal perspective.
I would add to your fintech coming from the top down, we actually have a portfolio company that's building institutional trading infrastructure for clean energy assets, so enabling trading hydrogen and carbon at an institutional level, which if you think on the top-down basis, that enables every other layer of these clean energy markets to operate.
That's actually a perfect segue into the next question, what I was going to ask about, so Climate Tech VC, it's a Substack and newsletter, great resource. They said it's going to take 2 business cycles to transform the global economy. And pretty much every sector of the global economy needs to become carbon neutral. Do you agree, one, with that statement and also with the timeline, yes or no, and why? And how do you envision that we get there?
Yeah, I mean, I think generally I agree with that. I think to Tarek's point, it's not going to necessarily happen in the way I think a lot of people hope. I think our belief is that there is so much technology that's out there that's proven it's ready for commercialization today, and it can have a meaningful difference in the overall category. When we talked it was a great tee up the last conversation ending with methane. That's one of the areas, for example, we've been really focused on that climate broadly has not thought as much about. So when you think about the sources of greenhouse gas emissions, Carbon dioxide, even though on a 100-year warming basis is the vast majority of it, if you look at it on the next 20 years, methane, shorter-lived climate pollutants, and others like nitrous oxide have a much higher warming potential for every molecule of greenhouse gases that you emit. So 1% of the gas contributes to 46% of the warming if you look at it on the next 20-year basis. And so that's the kind of stuff that when you talk about the turnover of the business cycles, you can actually have a higher bang for your climate buck at the end of the day if you figure out how you can best prioritize the most nearest impact sort of things. And so that's a lot of where I think people are starting to get much more smarter and savvy as climate investors and the climate community broadly, and getting into that insights of that next, what is it going to require over those 2 business cycles in order to ultimately get to where we want to go, whether it's net zero, 2050, all the other, everyone's got their own flavor of the different goals and whatnot, but it's all looking in the same direction at the end of the day.
I'm going to add to what you're saying. I actually think the most tangible way that we've seen it, both from an investment perspective and where people are building right now, and it's super topical, but anything supply chain related. So everyone's trying to innovate a different part of the supply chain, whether it be food and beverage. We have a team that's building a platform from a technology perspective. It's purely SaaS that enables renewables programs. So, Sweet Green or whatever chain can actually institute operating their kitchens on renewables in a way that scales. Or someone building in the construction space analytics and software for how do we actually, tackle the fact that 8% of emissions come from concrete. Like, what are our other options? How does that actually impact our bottom line from an output perspective, et cetera? And so just exploring all these channels. Sounds
No, I thought you were handing over me the mic. So basically, the way I look at it is if we say we need 2 business cycles, that's like an arbitrary number. We don't really know when we have to be net zero. And the person who wrote that article, by the time 2 business cycles pass, is their career is like they're retired. So there's no career risk by saying 2 business cycles. So what we need to focus on is what we have in our purview and what each individual has in their purview. And so how do we invest in things that incentivize the right behaviors on the individual level, and then the individuals will start buying the right things if those things are cheap enough for them to buy. Governments can do their part, let's say, with subsidies for electric vehicles and pushing that forward. But it has to be based on an incentive structure, I think. And I can't really comment on when we have to get to net zero. We obviously agree that we have to be more like carbon friendly and get to net zero. And I think that's possible, but that's possible with technology and with investing in things that incentivize the right behaviors.
I think one additional thing that I would add to that, there's been a lot of focus on individual incentives and trying to derive consumer demand. There's always these classic examples of, plastic straws and stuff like that. And, that's all helpful at the end of the day, but I think ultimately what gets to the heart of a lot of what we've been talking about here is that it's a systems problem, first and foremost. And that's a very complicated, there's unintended consequences, right? If people forget that 20 years ago, everyone thought that natural gas was going to be the panacea that got us off of coal and all these, dirtier sources of energy, which is great. But the unintended consequence that people didn't appreciate was the impact from methane and the leakage and all the rest that comes with that. And we're going to need that in order to help affect the transition as a transition fuel. But at the end of the day, we can't be having all this methane going into the atmosphere as well. And so I think getting to is it 2 business cycles, is it whatever, it's hard to know because this is such an incredibly complicated problem at the end of the day. One of the things, right now that I'm sure you guys have been seeing this as well, that, green hydrogen is the topic du jour all of a sudden. I don't know, people got bored with the last thing and they'd start talking about the next thing. And, one of the unintended consequences that a lot of people don't appreciate is, they talk about how hydrogen can be piped in your traditional natural gas pipelines and all the rest of it. But hydrogen as a molecule is a lot smaller than methane. So it's actually easier to leak out of the pipelines. And hydrogen is actually, it's not 80 times as potent as carbon dioxide, but it's about 40 times as potent as carbon dioxide. And so we could invest all this capital into getting to green hydrogen and having a hydrogen-based economy and just having created a new problem in the process. And it's not to say that I'm not an advocate for hydrogen, for against green hydrogen or anything like that. I think there's absolutely a ton of use cases, but I more bring that up as a point of the complexity of the problem, how it's hard. It's easy to make these sweeping points, but at the end of the day, it's really hard ultimately to understand exactly how it's going. But we just have to keep chipping away and trying to ultimately get there with incremental progress.
That's a good segue to the next question. So curious to hear your perspective on carbon removal technologies, because you talked about hydrogen maybe creating problems. Is carbon removal, what are your thoughts on that? And also all these additional emerging technologies that maybe don't exist, and maybe some advice for entrepreneurs that are kind of building in that space.
I guess I got the mic, so I'll kick it off. So I think the interesting thing with carbon removal is I think it's become very clear that it's going to be a necessary part of trying to solve the overall problem. But I think at the end of the day, there's a lot of questions on who is ultimately going to fund this, and what does that look like, and is this just a shield for others to basically keep emitting emissions? And so I think the nuanced approach that I applaud a lot of the efforts like this last week from Frontier and Lower Carbon and others, where it's focused on the fact that it's not just about storing carbon, but it's actually the amount of time that you're storing the carbon. So they're looking for solutions, for example, that are going to be 1,000+ years, locking those carbons somewhere underground. Those are the sorts of things that can make a difference. But ultimately, when you look at a lot of your carbon capture and sequestration technologies that are out there today, I think some of the risk that you run is that it also can be a bit of a tool for just kind of greenwashing with the status quo. And so I think that it's absolutely a necessary tool, but I think there has to be nuance around what are you capturing, why are you capturing that, and is that actually the best approach for addressing that problem versus maybe switching to a different fuel or an entire different industrial process entirely. So I think that's something that we've gotten really excited about, is that there's been a lot of these processes that people have said, oh, we'll just throw carbon capture on top of it. And we're actually seeing new innovative approaches that don't require the legacy processes, and you don't have to capture carbon because it's using something entirely different at the end of the day.
Yeah, no. I totally agree that the two need to be coupled, but in a way that doesn't enable greenwashing. But I think that what we've seen from so many of the industries that are trying to tackle this from the ground up and be the innovative solutions for the next generation systems, we've still inflicted a ton of damage. So that for us to reach the goals that we want to by 2050 being net zero, we most likely have to couple it with carbon capture.
So I personally want to go to Mars one day, and I think to get to terraform Mars, you're going to have to remove a lot of carbon from there. So hopefully we have the technology to do that by then, and hopefully that technology can be put to good use here on Earth. But ultimately, I think it's an incentives problem. But once again, it's if it's who's going to pay for it. Is it profitable? I think trees do it really well. So what we could do, and I've seen companies where it's like corporate carbon credits, and then the corporation pays for those carbon credits and somebody plants the trees or something like that. But the specifics as to how it's going to be done, I really can't have an opinion on that one just yet.
So there's different types of climate tech investors, right? It's 5 different categories. There's climate first, climate sector specific, impact, deep tech, generalist, some examples. How should entrepreneurs strategize which to approach?
So I don't think they should strategize which to approach. I think your background and what your personal perspective brings into what you want to build should be intricately tied. You shouldn't be going after one of these verticals simply because you think it's the most important one to tackle. I think you should be building what you are strongly suited to build, and that would have the strongest impact.
Yeah, I think sometimes I can have an allergic reaction to thinking of myself as just a climate tech investor, because ultimately it's much more about everything is climate at the end of the day in some form or fashion. So it's much more about what are like the next kind of industrial revolution in some ways, and there's a lot of different ways that you can play that. So kind of building off of what Valentina said, depending on what your startup does, if you're if you've got an innovative biological process, there's a lot of great biotech investors who are not climate investors, but are great for exactly what you're doing. And I think what you're seeing the industry broadly is that there's a lot of folks that are climate first and climate friendly and all the rest of it. But I think what you're seeing is that tends to be kind of a cover for kind of what's really going on. What are the areas that they actually focus on at the end of the day? So if you're an entrepreneur trying to look for that, I'd really look at like what are the areas that they're spending time on? What are they focused on? Because I think that's going to have a much greater impact than just whether you're talking to someone who is investing in climate or not. But obviously there's a lot of insight and knowledge that comes about from someone who's focusing on those areas than say, you're a SaaS software investor who's doing just that if you're working on that biological process, for example, right? And you could be both working in climate, and ultimately that's not a great fit at the end of the day. So I think it has much to do with that next layer down when you're trying to find that perfect fit with entrepreneurs.
I think ultimately, and from my perspective, at least in our thesis, is if you look at things like, going off what Valentina said, it's whatever you're best suited to do if you're an entrepreneur. But I think anything can really have an impact on the climate. If you look at, lab-grown meats, a lot of the emissions that come from the livestock industry can be removed by having lab-grown meats. There's companies that are building, advanced materials in space that can make cars more efficient and remove carbon from the atmosphere there before it even happens. So I think ultimately when you're building a company, think about how it impacts the environment. And I think if it's impacting the environment in a negative way, even though it's profitable, then you as an individual can make the decision, I need to change that. And if we incentivize those decisions on the individual level when you're building a company, then the next generation of companies that come to market will all be, net zero or net negative. We'll take carbon out of the atmosphere, and that's how I think you solve the problem. So yeah.
Right. So how do you, as an investor, prioritize the companies to invest in, whether that's, for commercialization or for impact? What are your thoughts around that?
I can take this first because we're probably the only non-climate specific fund. We invest in great talent, period. So whether what you're building has an application or a layer that has the commercialization aspect first, obviously, we have LPs, like that's who we are investing for. So what we invest in needs to make money. And if you have that second layer of enabling the climate revolution, that's stellar. Like I'm super excited about that, but we have LPs first. So for us, it's definitely the commercialization first, which is a harsh reality, but that's different for other funds, so.
I agree with that. It's all about, again, I've said this like 10 times. It's about incentives, because as a fund manager, I have incentives to my LPs have incentives to generate a return. So I have to find companies that, that make money ultimately. And so the second layer is, can those companies have a positive impact? And again, it's based on our thesis. Our thesis ultimately, if you invest in good technology tends to solve most problems over time. 20 years ago, without the video conferencing software that we have today, we would have gone through a pandemic and the economy would have crashed. But because of technology, we were able to actually not only be locked down for over a year, I don't know how long it was, like 8 years, but and the economy grew. And that's because we have all these tools at our disposal. So imagine what 10, 20 years from now is going to look like. That's kind of why I'm positively optimistic. And I think, it's ultimately about making money and being commercially ready. A lot of our companies on the space tech side, even, we say we don't invest in science projects, and a lot of space tech companies tend to, want to take this like NASA approach of long development, long R&D, and it's not mostly about the R, it's more about the D, the development of it. And so we need more D, we need more development, and ultimately, it's about commercializing and making money.
I think an interesting way to think about this is that you always talk about, it's about commercializing and making money, and that's obviously first and foremost what people are here for as investors. But I think the interesting part of this is that that's often said as a defensive mechanism because there's been such an overhang of investing in climate. You have to fundamentally trade that off, that you can't invest in climate and make money at the same time, or make as much money as you would if you didn't invest in climate. And I think the thing that everyone is not only waking up to, but is very exciting to see, is that you don't have to trade those two. I mean, the technologies that we are seeing today are fundamentally better than the legacy alternative, setting aside any kind of climate considerations. I mean, they're more efficient, they're higher yielding, they're better alternatives, whatever that might look like. And the climate impact from that is just a natural output from having fundamentally better technologies at the end of the day. And I think that's the real exciting part is that, I always hate having, you still feel like you have to have that defensive mechanism of like investing in climate. Hey, we're here to make money. And it's like, that should just be a given at this point. I mean, it is fundamentally going to be the next, kind of industrial revolution at the end of the day. And we're seeing it happening today. This isn't a show me thing. I mean, there's so much great innovation that's occurring right now. And it's not just in the R, it's in the D, it's in the development cycle. And that's the kind of stuff that we're ultimately going to need at the end of the day. And that's going to, I'm a believer in those market-based forces are going to work themselves out, and people are going to be rewarded for doing good because they've got just better technology at the end of the day.
I hope as VCs we believe in the market forces.
Right.
Yeah, we invest so early at the pre-seed and seed stage that I'm curious what you guys are seeing on later stages. But some of our companies, when they go out for our next round or they're in conversations with potential clients that they can launch their technologies with, get a lot of pushback that the market's not there yet, that it's too early, their technology is too new, or they just don't get it. I'm curious. You've seen them through the growth of they probably surpass that and come out on the other side, but what would you respond to that?
Yeah, I think that is interesting because we hear that all the time from entrepreneurs where they're actually, the companies we are offering engagement with are struggling at that point because they are at this kind of crossroads where they're trying to figure that out, and they are hearing that a lot. And I think a part of what we were purpose-built to do with our capital was actually help enable and unlock those markets so that you don't have those same questions at the end of the day. And so it is something that we see time and time again. I think that one of the big dynamics that are in play now in a much bigger way than I think it was even 5 years ago is that you're seeing a lot more strategic partners who are getting involved in the commercialization because they have their own pressures in terms of they've got their own net zero climate goals and all the rest of it. But I think they also are seeing that like their legacy businesses their lunch is going to get eaten if they don't try to co-opt the next and be participants in the next wave of technology innovation that's coming up. So I think part of what we find at our stage is that there's a massive coordination problem that you have to solve for to be really able to unlock those markets in a big way. But people are engaging and they want to do that. It's just, it's a different dynamic when you're scaling capital intensive infrastructure, right? And that's a lot of what you have. I mean, you see that in space as well and whatnot. It's a slightly different problem from building plants and whatnot. But at the end of the day, you kind of like, it's not like selling a SaaS software product when it's like you can get 200K here and 400K here and you can like slowly build a business. Like our companies, for example, one plant gets deployed and you go from 0 to 10 million in revenue overnight. And that's just something that people haven't been fundamentally conditioned by the last decade of venture success and what those businesses have looked like. And so I think that's created a bit of a shift in mentality that we see people run into at that stage. But it is a problem that people are well aware of, and they're figuring it out and all the rest of it at the end of the day.
I think comparing that to space tech, the funding cycle of, say, building a rocket, what Elon did is he made it exciting. He made it sexy. And so he can blow up a rocket and his valuation goes up. I think we just did a transaction in SpaceX. I kid you not. And I have LPs saying, hey, can you place $50 million in SpaceX? I'm like, hey, why don't you do that in my fund? And you can't get access to shares in SpaceX. But it's because he's made it sexy. He's made people believe in that ultimate vision. So I think with like capital intensive projects, what you need to do is you need to have clear-cut milestones, hit those milestones, even if it's not profitability, whether it's generating revenue or some of our companies really build a book of LOIs. For example, Radiant Aerospace is building a space plane, and what they did is they had $1.5 billion in LOIs. They went to market and they raised a $27.5 million seed round. So these monumental problems or big, long time horizon type of companies can be built in space, and the same models can be applied in climate tech. But ultimately, the end goal has to be this company needs to be profitable at some point, and there has to be a business case that closes at some point. How you get there is through like the different levels and scales, but giving incentives all through the path.
I think the strongest incentive any climate tech company can give right now is meaningfully lowering costs at the same time that they're actually creating the climate value.
Yeah, we like to think a lot of our businesses we've invested in, they're not making incremental cost improvements. They're literally eliminating entire steps in the process. And so it's not a 10% reduction in cost, it's a 50% reduction in cost. And I think we're seeing that across the board. And so that's the kind of stuff that gets most climate investors excited at the end of the day.
Yeah, and we're going on this topic like back and forth, but like this company we invested in called Dana Resolution, what they do is, so most solar panels are built in an array. That array, if you cover one piece of the solar panel, the whole array goes off. So if there's like dust on one part of the solar panel, the whole other solar panel can't harness energy. And so what Dana Resolution did is they built a microchip for each individual piece of the array. So even if one piece is blocked, the rest of it can still harness energy and store it. And so I think also another piece that is just the infrastructure for those big problems. That's how you drive costs down. That's how you make the business cases close, and then ultimately that's how you could solve the problem. So it's I think we talked about it earlier. It's incremental changes, like what is in the purview to tackle that big problem.
I'd love to hear a little bit more about, because you guys mentioned some of the companies that you're invested in, and like that's awesome about the solar company you mentioned. Can you share a little bit more about these companies and like the innovative technologies that are happening and how they're sort of, being trailblazers in a sense?
So I'll piggyback on what we were just saying about costs. The circular supply company that we backed, it's called Topanga.io. They enable, like I said, supply chains to be circular. What's really exciting is when you think about this as a restaurant or a CPG brand, I used to be a CPG founder, so I know this intimately. You have a major part of your costs that are you're spending on packaging. If you're buying into a closed loop supply chain, you're actually amortizing that down to zero. So in the long run, you're spending zero on packaging because you're getting over 90% retention of the packaging coming back and forth through your loop. And in the end, you're actually eliminating an entire cost basis. So that's one company that we're very excited about.
Well, this is not really spacey, but it's part of our thesis. It's called Isuzu. What Isuzu does is they actually just got, it was our first unicorn in the portfolio that we invested at the early stage. SoftBank came and was like, here's $100 million. 6 months after we invested, we're like, that's cool. But what they do is they do rent reporting to the credit agencies. And what I found really interesting about this company, and we considered it part of our fintech thesis, is low-income families spend about 35 to 50% of their income on rent. And if they cannot build credit adequately, they get stuck in these payday loans, and it's a revolving like circle of poverty. And if you're in poverty, you don't care about the climate. You just want to see where your next meal is coming from, how you're going to make rent. And so what these guys did, the founders are incredible. Their stories are like really aligned with what they're building, and they have like a personal tie to it. And what they do is, so you pay your rent on time, and that rent payment goes on your credit report, and then it builds your credit up over time. And those incentives that allow that good behavior build wealth, and that wealth ultimately will translate to better decisions on the individual level. So that's one of the companies we invested in. Check them out. They're called IsuzuRent.com. Super good company. They did a partnership with Fannie Mae and Freddie Mac. And so, yeah.
Yeah, so one of the businesses I mentioned earlier in the conversation is a company called Evernew. It's one of our more recent deals that we did. They're in the circular fashion space where they can take textile waste. They're starting out with cotton waste, and they can basically depolymerize that and create a pulp that's similar to think about like pulp and paper and whatnot, but instead they can extrude that into a fiber similar to cotton and mammoth and other kind of woody biomass-based fabrics that you might have in your clothes. But the fundamental piece of that that's the real innovation is that a lot of the historical recycling technologies would basically shorten the length of those fibers, so basically like degrade the material through that process. So you might be able to recycle it that one time, but then you can't go back again because it's been shortened too much. So what they do is that they actually preserve the length and strength of those fibers, and through that process, the tenacity of the fiber coming out is actually similar to synthetic fibers. So it's 3 times the strength of cotton, but it's got the nice texture of cotton and what you would typically want to see. And so you can start basically with a waste product that is typically being found, in a different part of the world than where a lot of your cotton production, for example, might be located. And instead, so getting to kind of supply chains and all that, instead you can basically create 100% waste content fiber, which they just publicly announced this 2 weeks ago. It's an industry first, because most of the you probably may or may not be aware, but most of the clothes you have, if you've seen recycled content, it's only about 20 or 30% recycled content. They have to blend it in with pristine fibers, so whether that's cotton or synthetics or whatever they're blending it with. This is 100% waste content fiber. So they just did this limited run, getting to the points around commercialization. We're building a big plant in South Carolina right now, bringing a lot of actually manufacturing capacity back onshore because most of the waste is being generated here in the U.S. as opposed to, if you think about where's the big consumption of demand. And with that, they're doing these limited runs, these small commercial proof points, like that sold out in 2 hours. The run that they had with this first one. So they've got some few others with other brands that they're kind of innovating around. So I think to some of the earlier points around entrepreneurs and how you can prove that is like, if you can find incremental little proof points like that on your way to that big, first commercial facility in our case, that's just some other advice that you can see as a proof in real time.
Are they relying on waste sorting capabilities across the waste management supply chain right now? Like, how are they?
It's both. Yeah, so they have their own sorting capabilities. So I mean, they are. So it's an getting to when we talk about this climate being a systems-based problem. Logistics around handling textile waste, for example, is a massive coordination problem. And so the low-hanging fruit that they're starting with this first plan is that there's massive amounts of post-industrial waste. So think like when they're making your T-shirts, there's a lot of scrap waste that comes from that. That might be either landfilled or incinerated because they're just kind of these random scraps they can't do anything with. Instead, basically, we can take all of that and start this process anew. When you start getting into pre- and post-consumer waste, which is either shirts that go unsold in a store, or you've worn it for a while and instead of throwing it in the trash, it's got a bunch of holes or whatever, and so you can kind of donate it and go in that. That requires, to your point around supply chains, an entirely different coordination problem that our technology can handle all of that today, but it requires some other forces that we're working on in terms of needing other partners who can handle all that in other parts of the value chain to bring those. So that's partnering with brands, malls, things like that, right? If you have like a collection point where people can just drop their their shirts off and whatnot, and then we can handle it from there. But then there is sorting and there's other capabilities downstream of that. So you'll see there's kind of all these refinements getting to your points around kind of the supply chain and whatnot.
I think that ties back to your question of founders targeting specific parts of climate. If you can find these like unique pain points that tie to the industry you're in or that you're passionate about, like you care about fashion, but you have a supply chain background. If you can help the fashion industry tackle the problem of how do we deal with how waste is sorted and upcycled and going through the entire life cycle. Just basically center it around finding a problem that you're actually directly relevant to solving.
100%.
Yeah, that's great. You guys have given some great advice, and we'd just love to hear a little bit more. You talked about talent and commercialization. What are some characteristics of founders or companies that you look for when looking to invest?
So we typically look for technical founders, obviously. Like, you want to build something, can you actually build it? Ideally, you will have built something already to show us the fact that you're so eager to build something that, oh, here's your V1. Like, we are builders. That's what gets us the most excited.
And obviously we're a little bit later stage, but I think fundamentally most people are still investing first and foremost in founders. And we're still at a stage where the financial profile is still fairly early in the grand scheme of things, and so you're investing much more in the promise than what has been shown, at least on the P&L side of the thing. Technology is an entirely different story. But I think there is one thing that I've seen in the couple decades I've been doing this, is that at the end of the day, there tends to be like an it factor that I don't know how to describe, that like when you meet with someone, it's the way they talk about the problem, the way that they are so like intricately passionate about it and knowledgeable about it. And I wouldn't say that, like, I've seen plenty of people who didn't start out with being like the person to solve that problem, but it was something that they cared passionately about and just threw their lives behind it. And with that became the expert in whatever that is, problem that is that they're trying to solve. And it just creates a little bit of crazy at the end of the day that you see there, and it's that insane passion and drive and persistence that's required to start a startup at the end of the day. That you'll just it's hard to describe. It's just like this it factor that you can see where like this person's going to make something of what they're doing or not.
I would just add to your it factor, it usually has a strong combination of being both stubborn and malleable. So stubborn, and you're going to do what you say you're going to do, but you're malleable enough that you're recognizing the pivoting points that you're hitting along each way and responding to market signals in a really positive way.
On that note, I think what we like to look for is founders. So we mostly invest in engineers, so really engineering heavy companies. One guy is building a space station, and a lot of engineers tend to not have a marketing chip on their shoulder, or they don't know how to really talk about it, and they go in depth on like the problem they're solving and how they're solving it, and we come in and try to help them with marketing, branding, telling their story. But then there's like this one. I always love to like invest in founders where I leave the meeting and I'm like, that guy's nuts. And then you start thinking about it and you're like, actually, it makes sense. But you want people that are kind of insane a little bit, because to build a startup, you go through a period, and even like we started a fund and it took us 18 months to like get the first 600K AUM, and then the next 12 months after that we did 100 million. And so like a lot of founders quit before the 18 months are done. And so that insane factor kind of also leads to a resilience. And that resilience is like doing something when nobody else sees it except you, and it could probably not work and it probably won't work, but you're gonna pour your life soul like if it was going to 100% work. And that is a little insane. So we like to find founders that are crazy.
There's a phrase I like to say that's not novel, but I just like to say it, is that chips on shoulders put chips in pockets, and there's that stubborn persistence. Like when I think about Stacy, the CEO of Evernew, I mean, she's got this fiery Irish background. She's one of 12 kids or something like that, some insane thing like that, and time and time again, she's been presented with problems where she's just like, I don't care what everyone's telling me. I am going to make this happen. I'm going to will it into existence. And it's just like, it's like I said, that if factor where it's like you just don't take no for an answer, but it's also understanding how to get to a yes. So it's not just like about just banging your head against a brick wall. It's about how do I basically either go over, around, or through the brick wall in some way at the end of the day. It's the problem solving that comes behind that ultimately.
I also think it's really interesting to see a second-time founder, a third-time founder after they failed, because that shows like even more resilience. Like, oh my God, you got burned and you want to go back in the fire. And so, like, resilience, I think, is one of the most important things that we look for. Is like, can this person get beat up and thrown out the door and told no a million times? And we try to be, you know, there to support as much as we can when we do decide to invest. But yeah.
Awesome. Are there any questions in the audience? I'd love to hear. I guess I'll do the thing where I run out.
So I work at a venture advisory near the Port of LA, and you've touched on a lot of like green economy solutions, but I'm really interested in seeing how all your funds approach blue economy and blue tech, because like with shipping decarbonization and goods and transport movement, and the Port of LA being where 60% of U.S. goods come from, I think it's also a really interesting focus for climate tech as well.
It touches on our broadly investing in supply chains, but we're investors in Dray Alliance, so very intimately involved in solving that pain point. The founder was out on a boat going up to the cargo ships when there were hundreds of ships backed up in the port, like bringing them food and trying to understand how they could help solve the bottleneck.
We didn't invest out of the fund, but in Nuvo Cargo, one of our team members invested directly, and we haven't really been active in that space, to be quite honest. But ultimately, when we do look at companies there, it'll be like any other. Is it something that makes sense from an economic standpoint? Does the business case close, and does it make things more streamlined? Software is a big piece there, I think, for now, but we'd have to get a little smarter, and it's a little outside of our thesis at the moment.
I think fuel is a big element of shipping. So we have a company that can, help with creating kind of new sustainable, it can do sustainable aviation fuel, but sustainable maritime fuel as well. So some of the different approaches, like with methanol and things like that folks are working on. And I know there's another business in the LA area that we know well that's doing a lot of that as well. So I think, fuel is a big element of that, but I think it's also about rethinking supply chains as well, so that probably good in some ways for like the Port of LA by maybe not having to put so much through the Port of LA in the sense of, hey, could we kind of localize capacity and production? So like we've got a controlled environment agriculture business that can build produce in regions of the world that don't have a lot of localized production. So I always like to think of it as like bringing the farm closer to the table in regions that you can't normally have outdoor production because it's like really hot or really cold. And so with that, a lot of that is actually either shipped or air freight. And so there's a freshness element to that, but that's also a massive cost too. And so when you think about how can we help solving some of these coordination problems, there's some stuff that we don't need to grow elsewhere. We don't need to produce elsewhere. We could actually bring it closer to the end market and provide, and basically relieve capacity for, say, the Port of LA to have more capacity to move the things that we do need to be moving and hopefully avoid some of the bottlenecks, for example, that we've been experiencing for the last couple of years, for example.
Okay, great. Did you have a question?
Yeah, so currently, right, the government does a lot of the highest risk foundational science research in the world. I mean, they fund it, although it takes a long time to get things done in that sense. And VCs are looking to get earlier and earlier and earlier at these stages. What do you think about that? Do you think that that's something that VCs might, it seems a little too risky? For example, it took like 20 years of studying some random bacteria to come up with CRISPR, which is now completely revolutionizing biotech. But you would have had to look at this random bacteria that no one would have been looking at. What do you think happens in that gap? Do you think that's an access point for VCs, or who might step in at that stage? Exploratory, let's put it that way.
Yeah, I'll leave it more to the super early folks over here. But one thing I will say that we are seeing is that companies are getting to our stage faster. And a lot of that innovation is still starting in the lab. from academic institutions or others like that that are primarily funded immediately, ultimately out of the government. But I think what you're finding is that as early stage VCs are getting more into the earlier portions of it and looking at those innovations and are getting better at accelerating the innovation that comes out of that, folks are getting to market faster, so that even though they might be toiling away forever, we're seeing that the time from, say, the spin out of lab to really reaching true commercialization is really dramatically shortening, which is super exciting for everyone involved.
A lot of the funds that, like us, invest at the earlier stages are structured with fund models to be inclined to take that risk. If one of these companies or projects at the time actually does emerge with a breakthrough technology, you're going to 100x that fund. You're the first person in there. You're getting way more ownership than a later stage investor would get, or at least at a much lower cost than they would. And so you're incentivized to do it. Like, we'll probably make 20 plus investments out of this fund. Even if one of those is a crazy breakthrough, like, that's a great return on our fund.
Yeah, I mean, it's the barbell approach that she's talking about, and it's having funds that are specifically focused for that, and saving some follow-on capital for the ones that do succeed. And that's how you give people an initial funding for it. I mean, we're doing a space station, and it sounds crazy. It's like it spins and it has gravity, and it's really cool. And I'm gonna go up there one day. But I think there is an opportunity, and on a side note, most funds are 10-year life cycles. I'd love to get into longevity investing moving forward. That's like something we want to do with like Fund 3 and 4. And so when I started thinking about longevity, if like humans could live longer, what would that do to investment horizons, right? And then you would have longer time horizon funds, and then you could do even crazier things. But that's like a whole side conversation.
There's also a whole battle for. There's so much dry powder right now. Everyone's trying to invest, and so being riskier and going earlier is being rewarded because you're having access to opportunities that you would not have access to because some giant behemoth of a fund is going to throw whatever money possible at a seed round.
Yeah, and I think to that point, the other thing that you're seeing is that universities are getting savvier about ways to foster that innovation. So, for example, my alma mater, MIT, they have a fund called the Engine now that is purposely designed for finding that exact problem that you describe, and basically having no real long horizon other than they know that these need a lot of money and a lot more time than a traditional investor, and then they're going to capture all the upside that comes from that. I think that's something that's crazy to me because, like, when I was there as an undergrad, I mean, like, VCs coming onto campus was like a no-no. Like, that was like, we were here for the science and the engineering, and you had to go off campus if you wanted that. Stanford's obviously been different for a while, and some of the others, but today that's an entirely different story. I mean, VCs are crawling all over campus every day and all the rest of it. And so I think you're seeing that across the board is that folks are also getting savvier about how they actually can commercialize those technologies at those academic institutions that will hopefully shorten the gaps on those development curves.
Yeah, I think it's that context. Like, if you were, if you had like a separate fund where you just send people to the Amazon, it's like look for plants. I don't know what they'll yield, but.
It's actually great. Shameless first plug. We're doing this event called First Look, where we're partnering with all the research universities showcasing emerging technologies. So it's June 7th at the Skirball Center, for those of you that are interested in attending. Is there one more? Okay.
That sounded like a plant.
Yeah, that sounds like an awesome event. Oh, yikes. All right. Well, we have what is the number one criteria the VCs look for in a GHG startup? So like global emissions.
I mean, I think that depends on your end market. I mean, and I think it depends on whether that is a criteria. Some people have it explicitly. Like, we have an explicit mandate that our companies need to have it at full deployment of their technology, a gigaton of emissions per annum of abatement, which means we're taking the big swings, looking at the big sources of emissions. But others don't have that as a hurdle, just that it needs to have an impact, or they're investing in the picks and shovels around it, or wherever it may look like. So I think it really just depends on who you're talking to at the end of the day in terms of what they would look at. There's no one size fits all when it comes to that profile ultimately.
Yeah. For us, we're generalists, so we're more looking at what's the overall market this team is looking to either create or capture.
I guess I'd say, like, just is the guy crazy or not, or the girl crazy or not? No, but ultimately, it's at the early stage, you're looking for the team. And it's like, that's a very boilerplate answer, but focus on building a product that can be sold and has a big vision. So when a VC is investing early, they have, like she said, 20 or 30 investments that they're making, and they need 1 or 2 of those to be a massive return, so that returns the fund. And back to your question, it's like, sure, 19 of those could go bust and you could lose all your money. I'll tell my founders, go burn the cash, but in the process, show me something that can get you to the next round, and so on and so forth. And so whatever startup it is, as long as it can kind of get to that ultimate goal and the VC can have an exit, they can then justify the investment in their portfolio, whether it's just an initial bet or usually most VCs will save capital for follow-on. So yeah, that's just a general answer specifically.
Awesome. I think that's all the time that we have. Let's give our panelists a round of applause. Awesome. Okay, thank you guys so much.